Hey guys, I'm Faith Harmon, and today I want to be talking to you about the allowance method of accounting for bad debt expense. The first thing that I want to talk to you guys about is the conceptual framework behind it. What we're doing is we are trying to figure out how much of our receivables are we not ever going to see. When we are operating a business, we have a thing called a receivable. It's when we are expecting to receive cash from someone whom we have already provided a service or a product for. But logically, like if we think about it, not everyone is always going to pay. It's unfortunate, but it's true. It's a fact of business. So the allowance method is just a way to figure out how much do we expect to not collect at the end of the period. So the first one that I want to do is percentage of sales, because I believe it is the most straightforward. Percentage of sales is we take a given percentage of sales deemed uncollectible and multiply by our sales for that period. So this period we had $1 million in sales. If we multiply that by 2%, we get $20,000. What is this $20,000? Luckily for us, that is our bad debt expense straight off the bat, which is very easy for us to figure out. And so we have a contra asset called bad debt expense. I meant to say contra account. We have a contra account called bad debt expense. And a contra account basically just takes away from whatever account it is attached to. Bad debt expense is attached to sales revenue. So since we already found out our bad debt expense, $20,000, we're going to go ahead and increase that account by that amount. Since it is an expense, we're going to debit it. So $20,000. And since we are doing a journal entry, we know that we always need a debit and a credit, at least one. And so this instance, our credit is to an account called ADA, or the Allowance for Doubtful Accounts. ADA is a contra asset. It is a contra account for accounts receivable. So when ADA has a credit balance, it is taking away from our asset accounts receivable. Why this makes sense is because ADA is giving us an estimate of how much we do not expect to receive from accounts receivable. So in this instance, let's pretend that we have a client named Mr. Smith. And Mr. Smith owes us $800, but it has been 3 years and he has not paid us a penny. So we do not expect to receive it anymore. So what I'm going to do is I'm going to credit accounts receivable, decreasing how much I expect to receive from this $450,000 of accounts receivable that I currently have, and I'm going to debit ADA by the same amount. By debiting ADA, I'm decreasing my estimate now so that I expect only $1,900 of accounts receivable to be uncollectible from this point forward. So, percentage of sales, the key takeaway is that it gives you bad debt expense. However, accounts receivable, percentage of accounts receivable. In this instance, obviously, if you made the connection, we are not going to be multiplying with sales, but rather the balance of our accounts receivable for the period. So in this instance, we have 4.5% of accounts receivable we expect to be uncollectible. So I'm going to multiply that out and I'm going to get a number, 2250, I believe. Yes, that is correct. So what is this number, 20,250? It is not our bad debt expense, which makes sense because sales revenue is connected to bad debt expense, where accounts receivable is connected to ADA. This number right here is the ending balance of our ADA. 2250. Specifically, it is the ending balance because this X right here would be bad debt expense. If you can see, our ADA account already has $700 in its balance from last period. That just means that our estimate was a little too high and we didn't use it all up, which is great. It's actually fantastic. We collected more than we expected to collect, which is perfect, beautiful. So what we get to do now, since this is not a journal entry, but a way to find the number that is, we're going to work backwards and figure it out. So, what do we need this X to be for our ADA account to end at $22.50? And so I'm just going to subtract $700, my beginning balance, from it, and I get bad debt expense of $19,550. So that is going to be my debit, and then my credit to ADA is going to be for the same amount. Beautiful. Ooh, messed up. So I'm going to debit this account right here, which is my contra account for sales revenue. And I'm going to erase this X because now I know it. $19,550. Beautiful. So now, that is the major difference between percentage of sales and percent of AR under the allowance method. How we actually account for the write-offs remains the same. If Mr. Smith, in this instance, also still wasn't going to pay us the $800, we would do the exact same journal entry. The difference between these two is just what is our estimated bad debt expense. Thank you guys so much for listening, and I hope you guys have a great day.